Welcome to my monthly update on alternative asset fund administrator and auditor league tables. There are over 600 fund administrators and 500 audit firms servicing the private markets. I am George Evans from Convergence. Convergence is a data and analytics firm focused on the asset management industry globally. Note that alternative asset league tables are available only to Convergence clients. League tables can be purchased at the Convergence e-commerce website. Today, I will provide some commentary on the movement we saw from March 2020 to March 2021, and then a brief wrap-up of those headlines. I will be joined this month by two Convergence clients, Tom Gandolfo of Auditor and Bill Pidgeon. So let me start with comments on market growth for the 12 months ending March 2021. Advisors disclosed over 93,000 private funds, a net increase of over 4,800 funds. That's up 5.5%. And assets were disclosed of 22.8 trillion, a net increase of 2.4 trillion. That's up about 11.5%. The top 25 administrators won 47% of over 7,000 total new funds disclosed. All other administrators won 19%. Advisors who self-administer stayed steady at around 34% of that total. The top 25 administrators won 55% of new fund assets. All other administrators won 14%, and the self-administration market went to about 31% over this time period. Convergence continues to see strong year-over-year growth in private equity assets, about 19.2%, and venture capital assets, over 48%. Over this time period, advisors disclosed 23,600 hedge funds. That's down about 700 funds, about 3%. Hedge fund assets have increased about $500 million, or close to 6%. That increase was driven by appreciating markets and new net inflows into existing funds. Let me also make some brief comments on self-administration. This is a surprising number to maybe many of you. There are over 30,000 self-administered funds in the market, and that is up year over year over 400 funds. This represents almost 33% of all private funds in the market, slightly down from about 34% a year ago. The value of self-administered assets totals about 5.6 trillion. And that's up about 15%. This is still a great and tremendous opportunity for the administrator market, especially when looking at outsourcing or looking at lift-out transactions. Let me make some comments on headlines we saw with administrators over the last year. So, in summary, we saw market asset growth year over year of about 11.4%. Only admins 1 through 5 are not keeping pace with that growth. They actually grew at about half that, 4.5%. We saw administrators 6 to 10 grow at 16.5%. Administrators 11 to 25 grow at 21%. The self-admin market grow at 15%. And administrators 26 to 600 grow at 17%. So if you think about it, there was 50% growth for administrators 11 to 600. We think the top 10 administrators should really study that pattern. Last comment I'd like to make from a trending perspective is that advisors continue to move down market and that we continue to see transaction activity. We saw the SON acquisition of Straight and the TMF acquisition of VBO. Lastly, I want to give a shout out this month to a number of administrators for great year-over-year performance. All are Convergence clients: Gen 2, SEI, Apex, Auditor, and Morgan Stanley. A fantastic job and congratulations to these 5 firms. I would like to now introduce Tom Gandolfo, Head of Sales and Relationship Management in North America for Auditor. Tom, thanks for joining us. I'd like you to take a couple of minutes to talk about your company and yourself to get us kind of started today.
Sure, George. Thanks very much. So just by way of background, Auditor is a global fund administration and corporate services provider focusing specifically on alternatives. And we were founded in 2003 in Luxembourg and today operate out of about 20 countries. On the US side, we total almost 1,000 employees out of 9 offices. We have a lot of excitement in the business today. We had a couple of key milestones recently, crossing over the 3,000 mark for employees globally and hitting 1 trillion in assets under administration. So it's been a very first quarter as well. We've closed on a few acquisitions. We acquired 2 administrators, IPS Fund Services out of Boston and Strata Fund Services based in Salt Lake City. 2 really great companies that enhance our capabilities across private equity, venture, and the fund-of-fund space. We also opened an office in the Cayman Islands and acquired a London-based fintech company, Credit Vision, which is an analytics platform for corporate credit investors and is a really nice complement to our debt capital markets business.
So Tom, you guys have been busy and off to a really good start this year. We've been, Convergence has been impressed with your guys' growth. So speaking about growth, let's talk about the alternative markets and what you're seeing this year so far in 2021. You know, 1, what are you seeing? And 2, has anything really surprised you?
Well, you know, it's really remarkable to see. You know, all sectors are firing at the same time. There was a bit of a pause in fundraising for some of the smaller and mid-tier managers in mid-2020, and now those firms are coming back to market. You know, we saw the momentum build in the 4th quarter, and that's continued into the first part of the year. A lot of interest in direct lending funds, logistics in the real estate space, some opportunistic strategies. There's been renewed interest in the CLO market, and the list goes on and on. And for us in the fund administration world in particular, I think we are doubly blessed, not only with a strong market, but a manager community that continues to trend from self-admin to an outsourced model. And I think COVID has hastened that a bit. You know, managers are seeing the benefits of scale and technology, and there's more of a comfort level that your fund accountant does not need to be right down the hall from you anymore. You asked the question if anything surprised me. I think the only thing that really surprised me was the speed of the market's recovery. And I think a lot of the credit goes to the government stimulus. The size and scale were at a level that really assured the market and got things moving quickly. And it really reinforced kind of the resiliency of the alternative space in general. I think people are seeing it as a very mature market today, and managers were prepared to shift gears in the crisis.
Yeah, no, I think I agree. I mean, and you throw on top of that, you know, performance for many of these alt vehicles was pretty terrific in 2020. What do you think the biggest challenges, Tom, are that you're seeing in the market as a business today?
So, you know, we still haven't returned to a new normal yet. You know, most colleagues and clients are working remotely, and we continue to manage in a pandemic environment that changes by the week. You know, the focus on employees is paramount. I think engaged executives and HR divisions, which stay close to employees, is important. Having flexible work arrangements and ensuring that, you know, our colleagues have the tools to be successful in their job. You know, all these things have had a hyper focus during COVID and will very much continue to be important. So on the client side, you know, I wouldn't use the term challenge as much as adaptation. You know, without the coffee, lunch, or office meetings, we've had to adapt the way we've engaged with clients. Video conferences are the norm for client discussions, due diligence meetings. You know, in terms of outreach, webinars and podcasts have taken the place of in-person conferences. Presence on LinkedIn and thought leadership is really important. And within Alter Domus, we put out a publication called Census on industry topics every couple of months. It's a different way of engaging than the traditional handshake meeting, but effective as well in maintaining your brand.
Yeah, no, that's well said. So you talked a little bit about advisors being more comfortable now with kind of outsourcing and moving from a self-admin market. When we shift to advisors, what are you seeing advisors asking you for, say, most frequently these days?
There's a few things that seem to come up in every conversation today. You know, from a fund administration perspective, the blocking and tackling of fund accounting and asset servicing will always be the core to the business, and managers want to ensure that you're staffed with competent, capable people that can perform the job well. But along with that, you know, firms in our space that are successful need to continuously invest in technology and processes to keep pace with the evolving needs of asset managers and investors. Working to take out the manual functions, automating as much as possible. Utilizing portal technology for data is just the start. For us, we just rolled out a digital subscription process. We're employing robotics and OCR technology in our businesses. All these things are really, really important to be successful and are top of mind. The other thing that I think not only advisors, but the market in general care about are ESG initiatives. You already started to see the shift pre-COVID. And what we're hearing from clients in the market in general is that economic distress and societal disruption of COVID has put an even larger spotlight on ESG priorities. And most LPs have ESG standards today that need to be met before they participate in deals. From a private equity standpoint, it's part of their entire process, from diligence to how they source investments and add value. There was a McKinsey study that's often cited that companies are willing to pay a premium to acquire firms with strong ESG platforms. And the data also demonstrates that gender and racial diversity correlate to higher financial returns. So it's not only a societal good, but the economic supported as well. It's a key initiative for us at Alter Domus. We have established an ESG mission and have steering committees to that effect. It's a big part of what we do and something clients ask us a lot about, and employees care very much about as well. So it's also a part of our recruiting process.
Well, so Tom, really exciting times at Alter Domus. I want to congratulate you on just a great performance, a great job that you do, and really want to thank you for joining us today. So thanks very much.
It's been a pleasure, George. Thanks again. I appreciate your time.
All right. Let me now turn to the audit space, and I'd like to talk about market growth over the last 12 months ending March 2021. Advisors disclosed over 92,000 private funds, a net increase of over 5,400 funds. That's up 6.2%. They disclose assets of 22.5 trillion. That's a net increase of 2.3 trillion, up about 11.5%. The top 25 auditors won 70% of 7,200 total new funds disclosed, and all other auditors won 6%, while 24% of funds did not report a fund auditor. Funds not reporting auditors represent funds that are not subject to an audit or are subject to an audit and they're in the process of selecting an auditor. This is a great opportunity for our friends in the audit and assurance practices. The top 25 auditors won 89% of all new fund assets. All other auditors won 2%. On this front, Convergence continues to see strong fund and asset growth on the closed-end front, PE, VC, and real estate, with PE growing close to 19%, VC close to 50%, and real estate close to about 9%. Funds and assets growth in hedge funds increased, with advisors disclosing close to 23,100 hedge funds. That's down over 500 funds over the last year. Hedge fund assets were up about 500 billion, about 6%. That increase in hedge fund assets was driven by appreciating markets and net inflows into existing funds. The number of funds not reporting an auditor is close to 15,000. That's a substantial number, and that's up about 4%. Let me just make a few headline comments about the audit market over the last 12 months. So we saw market asset growth year over year of about 11.6%. The Big Four certainly kept pace with that growth at about 10.4%. Firms 5 to 10 were about 16.5%, and auditors 11 to 25 were about 21%, which is fairly substantial, and that's almost twice the asset growth we see in the market. This month, I do want to give a shout out to some great Convergence clients on the audit front for a great year-over-year performance. Those would be Price Waterhouse, Deloitte, EisnerAmper, and BDO. Comment I would make here is that advisors are clearly also moving down market in the audit segment. I'd like to introduce our second guest, Bill Pidgeon. Bill's partner, co-leader of Cohn-Resnick's Financial Services Group. Bill, welcome to the podcast.
George, thank you very much for having me. Really appreciate it.
Yeah, it's great to have you. And I would like you to start, Bill, just talking a little bit about yourself and Cohn-Resnick.
Sure, that's great, George. Thank you again. As George mentioned, my name is Bill Pidgeon. I'm co-leader of the financial services practice at Cohn Resnick. Cohn Resnick itself as a firm was founded in 1919, and today we have 25 offices globally, including the Cayman Islands. Within our alternatives investment practice, we provide audit, tax, and advisory services to over 900 funds, including hedge funds, private equity funds, venture capital funds, and real estate funds. We serve funds at all stages of growth, starting with emerging managers to funds over $1 billion of assets under management. Within our alternatives investment practice, we also provide advisory services, including due diligence and valuation services.
All right, Bill, terrific. That's great. Well, listen, let's start with probably my first question. I'd really like to hear from you on 2021 and the growth opportunities you're seeing in the alternative market. So what do you think about growth? And secondly, has anything surprised you?
Sure. So far in 2021, we're really seeing a broad range of opportunities. From a new launch perspective, there are several areas that really stand out. Cannabis funds, debt funds, real estate funds focusing on multifamily opportunities, as well as private equity funds focusing on technology, healthcare, and renewable energy. During the fourth quarter of 2020, we were also receiving calls from established managers that felt they needed more personalized service and partner-level attention given the changing regulatory environment. This has continued into 2021, and we expect that trend to continue throughout the year. As far as surprises, George, there are three things that stand out to me the most. First is the rapid recovery of valuations from the March 2020 lows to the end of the year. Last year at this time, we were having a lot of calls and Zoom meetings discussing the impact of the pandemic on our clients' first quarter valuations. By the end of the year, the majority of those portfolio companies not only recovered in value, but several had seen great appreciation from the beginning of the year, especially those in the technology space. If you told me last March the markets were going to recover so quickly, I'd probably have a lot less gray hair today. The second surprise is that really the limited number of fund drawdowns and closures. The majority of our clients did not receive redemption notices, but rather a good number of them actually received capital inflows for April 1st, 2020 investment. The third and final thing that stood out to me, George, was the increase in the number of fund launches and ability to raise capital towards the end of the year and into 2021. The due diligence community and fund managers had to pivot quickly from in-person to virtual meetings. During the middle of 2020, nobody knew how long the pandemic would last, but as it became more apparent it would not end anytime soon, the industry adapted, and as I mentioned previously, we are seeing a good number of fund launches today.
Well, listen, I think I agree with you greatly, especially on that third point, Bill. You know, we saw with the capital formation work that we do, just a lot of dry powder, right? Sitting in
Yes.
20, right? So let's move to market challenges. You know, if I had a hard question, but if I had to ask you to just kind of think about that, what are the biggest challenges that Cohn Resnick's seeing in the market today?
That's a great question, George. So just as the due diligence community had to quickly shift from in-person to virtual meetings, so did we. Instead of relying on conferences, dinners, the typical networking events that we're all so used to going to, we had to shift to an all-digital strategy that included thought leadership and webinars. Of course, as the year progressed, we've really started to sense a growing fatigue in attendance of seminars, so we again pivoted to more curated events and smaller group virtual meetings in order to stay in contact with clients and prospects. We are constantly looking for new and innovative ways to keep our employees and our clients engaged as they all continue to work from this work from home environment.
All right, Bill, let me go to my next question on advisors. So your clients, what are you seeing advisors kind of focused on these days and asking for most frequently?
Some things never change, George. Advisors just continually care most about generating returns for investors and raising capital. That being said, this past year, advisors faced a new set of challenges. And I'd like to highlight two of those topics that are generating a lot of interest at Cohn Resnick. The first topic relates to cybersecurity risks. The SEC has recently identified information security and operational resiliency as one of their top examination priorities during 2021. The division is expecting advisors to have taken measures to safeguard client accounts, address malicious email activities, and manage operational risk as a result of employees working from home. Also recently, there was a great segment on 60 Minutes where Federal Chairman Jerome Powell further drove this home in an interview where he said, and I'll quote, "The world evolves and the risks change as well. I would say that the risk we keep our eyes on the most is now cyber risk. That's really where the risk is, I would say, is now rather than something that looks like the 2008 global financial crisis." This past year, our advisory practice has spent a lot of time helping clients assess cyber risks and conduct threat analysis and breach detection. The second topic that we're hearing a lot about and talking about at CohnReznick is ESG. Due to the high level of interest in ESG investment programs, this past February we held a panel discussion. The panel discussed the expectations of allocators and limited partners, and I'd like to highlight a few of those areas of interest for you. First, participants want to know that ESG is truly embedded in the advisor's investment process and not simply an attempt to check a few boxes in a due diligence questionnaire. Second, they also want to know if advisors are applying appropriate ESG measures in their own firms, such as adopting diversity and inclusion measures. And finally, one of the other things we saw was that allocators and limited partners, they really want to see evidence that the relevant factors are being regularly monitored for each portfolio company, including an annual report showing the status for each investment and progress relative to the prior year. And as we all know, as with cyber risk, the SEC is also keeping a very close eye on ESG investing. I would actually encourage everyone to read the April 9th, 2021 Division of Examinations risk alert related to ESG. I think that really will show you what the SEC is looking at today as they go through their examinations, especially related to ESG investing.
Well, that last topic, Bill, is really interesting. We recently published something that talked about SEC examiners are starting to see unsubstantiated and potentially misleading statements and are seeing and recognizing questionable processes around with some investment advisors, particularly when it relates to ESG products. So I agree with you. I think that's something that we all need to keep our eyes on. Well, listen, Bill, I want to thank you for joining us. You sound very bullish about 2021. These are pretty exciting times, and I want to congratulate you and all of CohnReznick for really a great performance over the last year. So thank you for joining us.
Thank you very much, George. We really appreciate our relationship with Convergence, and thank you very much for this opportunity.
All right, terrific. I'd like to recap with some final comments. On the administration front, we saw year-over-year asset growth of over 11%. Admins 1 through 5 not keeping pace with that growth. Admins 6 through 10 growing at over 16% and 11 to 25 at over 21%. We saw very substantial growth in administrators 11 to 600. On the audit front, we saw market asset growth of 11.6%. The big four kept pace with that growth. Audit firms 5 through 10 at about 16.5%, and audit firms 11 to 25 at about 21%. I'd also like to recap some of what we heard from our guests. Both were very bullish on the prospects for 2021. Both were surprised by the speed of the market's recovery and valuations. They saw a lot of client adaptation to COVID. Strong presence and thought leadership for their firms was very important during the COVID crisis. They both thought technology investment and particularly cybersecurity was an important issue during COVID. We talked also about strong ESG programs at advisors. And lastly, both mentioned the ability for advisors to raise capital during this COVID time period. Lots of dry powder in the marketplace. I'd like to thank our guests, and I'd like to give you some final thoughts today. It's important to operate across all asset types. Closed-end growth will continue to outpace open-end growth. I see the European-based administrators really giving the large US administrators a run for their money. I also see some shakeout in the top 10 audit firms. Please contact me or Convergence if you have any questions, and we will see you next month. Thanks for your time today.